Thank you. Thank you very much for a very warm and nice introduction. I feel honored very much to be invited by Monash University's Business School. Today, I'd like to talk about Asian development outlook. This is the ADB's major annual publication, flagship publication, providing a comprehensive economic analysis of 45 developing Asia and Pacific economies. So-called the DMC, developing member countries, 45 developing member countries of ADB. And actually, we usually publish main report in April. And this time, I'd like to share with you update, which revises the forecast, growth forecast, which we presented in April. And in addition to this revised outlook on Asian growth and inflation forecast, we also include in this report in-depth analysis of the theme, sustaining development through public-private partnership, focusing on medium-term issues of Asian economy. So I'm Yasuyuki Sawada, Chief Economist of Asian Development Bank. So before getting into the contents of report update, ADO 2017 update, I'd like to share with you three key messages in this update. Number one, resurgence of global trade and favorable domestic demand, lifting developing Asia's growth outlook. So this region is now expected to grow faster than our anticipation in April. Now 5.9% this year over all Asian Pacific region and 5.8% next year. Excluding already high-income countries in this region, Korea, Taipei, China, Hong Kong, China, and Singapore, excluding these already high-income economies with a lower growth rate, this year's growth is 6.4%, and the next year is 6.3%, even higher. Part of story is a picking up in growth of People's Republic of China. We upgraded PRC's growth rate, 6.7% this year and 6.4% next year. India's ongoing structural reforms establishing the basis for long-run growth, but short-term challenges have led us to pare down our Indian growth forecast. Now this year 7.0% and 7.4% next year, making it faster, still making it faster, fastest growing, largest economy in Asia. A second key message is Asia has been benefiting from the resurgence of global trade. Trade along supply chain seems to be expanding in last 1 year or so. So this is a good news. And China is now moving up the ladder of supply chain. So their structure, industrial structure is upgrading. And other following countries such as Vietnam and Bangladesh has been benefiting a lot from this China's moving towards the higher end of manufacturing sector. Finally, as I mentioned, this report, second half of this report, we talk about the medium-term issues, and public-private partnership is the theme of this update. What we have learned about making a private sector a more effective partner in providing infrastructure for development, this is quite critical, and the financing needs are huge in Asia, and improving the way PPP, public-private partnerships, are designed and implemented is crucial for Asia to continue growth momentum, poverty reduction trend, and also achieving global climate change targets. So these are the three key messages I'd like to convey today. So now let's move into the growth forecast closely. So this figure shows the little bit longer term growth forecast. As we can see from this forecast, growth in Asia is now revised up to 5.9%, and April forecast was 5.7%, so 0.2% point upgraded. Next year, now 5.8%, previously 5.7%, so upgraded. And excluding already high-income 4 countries, 60 6.4% growth is this year. Again, slightly upgraded April forecast, and 6.3% slightly upgraded April forecast. Behind this, as I already mentioned, global expansion of trade. That's one factor, and also China's better than expected growth pattern in last 1 year. This is another cause. But behind this global expansion of growth, we can closely look at developed economies' performance. And ADB, we watch 3 economies. So United States, Euro area, and Japan. And these group of 3 or G3 countries now expected to grow at rate of 2.0%, slight upward revision from April forecast 1.9%. And this upgrade is largely driven by Euro area's better than expected growth, now 2.0% growth. Our previous forecast was 1.6%. Japan has been also strong in growth, 1.5%, as opposed to the prior expectation, 1.0%. So these faster recovery industrial economies are gathering growth momentum, improving outlook for developing Asian economy. So this is one factor behind stronger than expected Asia's growth. And partly because of this stronger demand, now we can see rebounds or rebounding trade. So left figure shows the our member countries' gross nominal exports. Orange bar chart shows the 2 years ago and 3 years ago and 2 years ago. What's the change rate of imports? Largely negative. So actually, exports are shrinking up until 2 years ago. However, last 1 year data shows green. So now last 1 year export bounced back, and now most of the Asian countries encountering growth in gross export. Imports, we see the same trend. Blue part shows the 2 years ago and 3 years ago import change rate, mostly negative. And now we see last 1 year data shows the strong positive import increase. So these are the one factor, driving factor. But we can also note growth of export and the growth of imports. It seems, largely speaking, growth of imports magnitude is larger than growth of exports. And this also reflects very lively and active domestic demand by Asian economies. Now let's look at the sub-regions. So top left is East Asia. Overall, East Asia, April forecast of 5.8%, but now we revise up 6.0% next year, also 5.8%. So upward revision, mainly driven by People's Republic of China's growth upgrade, 6.5% April forecast, now 6.7%, next year 6.4%. Other already high-income economies, Hong Kong, China, Korea, and Taipei, China, also economic growth performance is much stronger than our prior expectation in April. So altogether, East Asia is really accelerating growth. Southeast Asia, similar pattern. Overall, 4.8% growth, now 5.0%, and next year 5.1%. Most of the countries seems to gather momentum for growth, especially Malaysia, Philippines, and Singapore, partly reflecting strong domestic demand. The case of Philippines, we see government's public, very active, proactive infrastructure investment. So this seems to accelerate the growth. And next year, this momentum seems to continue. South Asia, overall growth downward revised from 7.0% to 6.7%, and next year 7.0%, largely driven by India. April, we set 7.4% growth, but now downward revised to 7.0%, although growth seems to bounce back next year. So I'm going to talk about India closely later on. Having said this, Bangladesh and Pakistan growth performance seems to be better than our prior expectation. Central Asia also, we see largest economy in Central Asia, Kazakhstan, now growing much faster than our prior expectation, and reflecting that overall Central Asia is growing faster than our prior expectation. And the Pacific region, our prior growth forecast remain the same. So there's no negative sign or negative shock or negative disaster affecting overall Pacific regions, especially PNG, largest economy in a Pacific region, 2.5% growth seems to continue this year. And the next year, slightly upgrade growth rate. So this is a picture of sub-regional growth performance. So now let's look into more closely what's the factors behind this seemingly better growth forecast than before. In order to do that, we can pick representative economies in this Asian Pacific region, PRC, India, and the 4 tigers, high-income East Asian and Southeast Asian economies, and then Indonesia, Malaysia, Philippines, Thailand, and Vietnam. So we can decompose first half of this year's growth rate, shown in yellow dots. So this is the overall GDP growth rate. We can decompose from the demand side. Although we can do also supply side decomposition, but we can closely look at demand side decomposition. Blue part shows the domestic consumption contribution to overall growth, and orange is investment contribution to growth, both public investment and private investment. And then green part is net export, export minus import. As we can see, blue part seems to show the largest proportion overall. So domestic consumption can now support growth rate of Asia. Number 2, orange part is also quite substantial depending on the country. So domestic investment also play a very important role, both public and private. However, net export seems to be negative in some countries. And as we have seen already, export growth now become positive. And import growth also became positive, but the magnitude of import growth seems to be dominating magnitude of export growth. As a result, we see overall growth contribution seems to be negative. Net export contribution seems to be negative. But we can say this is a reflection of very active domestic consumption, which cannot be met by domestic production. China, we see a slightly positive contribution of net export. So now let's look at 2 largest economies in this region, China and India. So this is China. So left is using a quarterly data. Again, we did the demand side decomposition of overall GDP growth. Orange part is consumption contribution, and this gray part is investment, and blue part is net exports. As we can see again, China consumption growth play a very important role, followed by investment, domestic investment. So China, as you may know, China is on a so-called rebalancing process of its economy from external demand-driven to more domestic demand-driven, and we can clearly see domestic demand play a very important role to support China's growth. But in last 2-3 quarters, we can see favorable external trade or expansion of a global economy seems to generate a positive impact through a net export contribution to overall China's growth. So this overall pattern can be supported by another indicator called the PMI, Purchasing Managers Index, which is based on subjective assessment of companies, those who are in charge of purchasing different products. actually purchasing managers index became positive in last 1 year or so. And this is consistent with slightly improving growth of China. And also gross export became, transformed from negative territory to positive territory. So this is also, again, matched with now net export positively contributing overall China's growth. India, we have a different picture. So again, left figure shows the growth decomposition from the demand side. So overall growth rate is moderating in India, and consumption expenditure contribution is shown orange, and investment is shown in this gray. We can see investment contribution became almost negligible in last few quarters, and consumption contribution also declining. So India domestic demand seems to be getting weaker and weaker, and that seems to push down overall growth. So what happened in India? So naturally, two big kind of policy change made in India. Number one is a demonetization of economy, November last year. And naturally, demonetization suppressed small businesses and cash-based private transactions. So that's the number one factors. Another one is national goods and services tax introduced, and that seems to mutate manufacturing sector and transaction probably temporarily. But these two policy reform, demonetization supposed to facilitate digitization of economy. So overall transaction cost of business will be substantially smaller, and goods and tax services that will definitely expand the fiscal space of the government. So we can expect public investment will increase in medium term. So considering these two factors, although we downward revised our growth forecast of India this year, but we expect India's growth rate will bounce back next year. So now we set 7.4% growth of India next year. And 7%, also downgraded, but still around 7% growth. This is not bad at all. If a country continues 7% growth over 10 years, that means economy size will be doubled. So definitely, having seen this temporal kind of a shortfall of growth, but definitely India is one of the fastest growing economy in this region. So ASEAN, as we have seen already, we upgraded overall ASEAN economic growth this year 5.0% and next year 5.1%, especially Malaysia and Philippines and Singapore, we upward revised growth rate. However, two countries we can point. Brunei, actually growth rate is downward revised, and also Vietnam. So Brunei, Vietnam, mining sector or resource-based sectors. Case of Brunei, oil, and the case of Vietnam, oil and coal sector slump seems to push down growth rate of these countries. However, overall growth performance seems to be upward lifting in ASEAN. So now turning to inflation and commodity prices, global oil prices have fluctuated somewhat in 2017 after a slight pickup in last year, but broadly became stable these days. Okay. As of 22nd September, Brent crude oil price was $55.8 per barrel. Year-to-date price is $51.8 per barrel. And we see some sign of slightly increase. But largely speaking, oil prices became stabilized and slight increasing trend. Commodity price, we see the same trend. Commodity price has been fluctuating a little bit, but now seems to be stabilized with some slight increasing trend. And reflecting these commodity market prices movement, our overall inflation forecast, April forecast was 3.0% inflation in Asia Pacific this year and 3.2% next year. But now seeing this better stability of oil prices and commodity prices, we downward revised inflation rate. This year 2.4% and next year 2.9%. Last 10-year average inflation rate was 3.9%, which is shown by this horizontal line. So 2.4 and 2.9 are well below 3.9 10-year average. So we can safely say inflation expectation has been well under control and well anchored in developing Asian Pacific region. So this is the first part overall outlook of Asia's economic growth and inflation forecast. What are the sources of risks? In April, we listed inward orientation sentiment may cause a negative impact on Asian growth, but this sentiment seems to be diminishing in last several months. Now oil price also seems to be stabilized. So risks to the Asian Pacific economy seems to become more well balanced right now. Remaining risks, policy uncertainty in the US, monetary policy, US Fed started unwinding a huge amount of balance sheet assets. So that may increase interest rate in the US. And as a result of this monetary policy normalization, capital outflow may be triggered. However, US Fed has been quite slow and very moderate and well communicated to the market. So we don't see this is a really big source of risk. And indeed, there is no kind of sign of large-scale capital outflow from Asia to other out of Asia region. Fiscal policy direction, still tax reform and spending on public works. There is still uncertainty, and also a plan has been already reviewed and adapted in the process of adaptation, but still there are some uncertainty in this process, and also this tax reform will come later on. Tax reform and spending, fiscal policy change potentially can generate positive spillover effects to Asia, but still we don't know yet what's the likely impact. Then finally, economic disruption coming from geopolitical or weather-related disaster. These are a potential concern, but these at right now, these risks are less likely. And rather, we have seen a rebound of global trade, and especially high-tech goods trade seems to be quite active. So these are potential risks, but it's not necessarily a really immediate risk. So in any case, developing Asia seems to be well equipped to manage these short-term risks and should do more to remove constraint on productivity growth, such as need infrastructure management. So Asia, rather than, because short-term risks seems to be well controlled. So now Asia, I think it's more important to looking at medium-term potentially binding constraint. So that's why second half of this Asian development outlook update, we pick public-private partnership as a very important issue. And this is very critical, one of the critical factors to make Asian growth momentum continue. So before talking about PPP, I'd like to share with you Asia has a huge infrastructure investment needs. Over 400 million Asians live without electricity still, 3 million without safe drinking water, and staggering 1.5 billion without basic sanitation. And left figure, so this figure shows the overall infrastructure needs estimate by our staff members. According to a relatively new report we released in February this year, we made a careful assessment of overall infrastructure needs in developing Asian Pacific region. Also, we confine our attention to 4 sectors: energy, transportation, ICT, and water sewage. So we only looked at the 4 sectors. Our quantitative analysis shows whole Asia needs 26 trillion US dollars investment over Sustainable Development Goal horizon from 2016 up until 2030. 26 trillion US dollars for 15 years means 1.7 trillion US dollars per year. This level of investment is needed for Asia, again, to continue growth momentum, poverty reduction trend, and complying with the global climate change Paris target. 1.7 trillion dollars per year investment needs in infrastructure, roughly 1 trillion for energy sector, followed by 0.6 trillion for transportation, then ICT and water. So we need lots of investment, especially in energy and transportation. Okay. So this is our background. Okay. Currently, what's the level of actual investment? Roughly speaking, around 1 trillion plus minus. Okay. So 700 billion or so, or 800 billion or so investment, additional investments are needed. Otherwise, growth momentum, poverty reduction cannot be continued. Okay. And also, I forgot to mention this, 1.7 trillion US dollars infrastructure needs. We included necessary investment to achieve Paris climate target. So climate change adaptation and also, mitigation and adaptation. As to the climate change adaptation, we included the necessary expenses to switch renewable energy and also making distribution system of energy more efficient and more climate friendly. As to the adaptation, we added cost necessary to cope with potential sea level rise and associated necessary investment in transportation sector. So climate change mitigation adaptation costs are included in 1.7 trillion US dollars. Roughly this adaptation, mitigation adaptation related costs are 0.2 trillion US dollars per year. Okay. So 1.7 trillion US dollars investment needed to continue Asia's growth. Okay. But 0.8 trillion, 800 billion or so are not, there is a gap. Okay. So how to fill in the gap? So this is our starting point. So that's why we pick PPP as a potential important mechanism to fill in this gap. Okay. So in order to talk about gap, actually 45 countries, 1.7 trillion US dollars investment is needed. But high quality data is available only for 25 countries and economies. And excluding China, 1.7 trillion US dollars investment for 45 countries. Excluding China, 24 countries with high quality data. Our estimate says 500 billion US dollars investments are needed. Okay? And 500 billion investment needs per year for 24 economies. Current investment is around 200. So rest 300 or so billion dollars investment gap exists. So how to fill in the gap? There are only two ways. One way is to expand government fiscal space and increase public investment. Okay. We can do a so-called fiscal space analysis. Government can engage in tax reform, expenditure reorganization, and also prudentially borrowing. Government can also charge user fees and non-tax kind of revenue, such as so-called land value capture. Land value capture is a way to finance a part of infrastructure investment. For example, constructing a railway, surrounding areas land value will increase. So this asset price value increase can be captured to make investment. So land value capture, etc., etc. So according to our fiscal space analysis, out of 300 billion unmet demand of infrastructure, about 40%, 120 or so billion US dollars can be financed through expansion of public investment. But rest, 60% of unmet demand, 180 or so billion, this money should be financed by private sources. Okay. So this is the only way. Then how to tap private funding? So that's an issue we'd like to talk about. And so I already mentioned. So in order to tap private funding, of course, the government can create conducive investment climate so that private investment can be coming, and also deepening capital markets to facilitate mobilization of private investment. Then PPP can also play a very important role. So that's why we pick PPP. So PPP is defined as, actually this is a sort of abstract definition. PPP is defined as a long-term contract between private party and government for providing certain type of infrastructure services or public services, in which the private party bears significant risk and management responsibility, then remuneration return linked to performance. So this contract between private parties and government, this is a PPP, and this has been widely used to finance infrastructure investment all around the world. In Asia, in last quarter century, number of PPP projects increased by 4 times, but regional disaggregation tells us PPP has been concentrated in East Asia, shown in red, followed by recently South Asia. Southeast Asia, still PPP is its infancy. Sector-wise, again, last quarter century data shows PPP-funded infrastructure projects dominated by energy sector, followed by transport, ICT. Little PPP can be found in water and sewage. So this is a big picture of PPP. Why PPP? We should focus on PPP. PPP is a hybrid of private sector and public sector. So we can mobilize private sector's dynamism in financing infrastructure. So private sector can basically potentially improve delivery, because private sector is highly incentivized financially, and also targeting always operational efficiency, conscious about operational efficiency. And also private sector is a sector which can proactively adapt new innovation. According to our study, using past quarter century panel data, we ran what's the impact of PPP on particular infrastructure investment, and also what's the impact of PPP on overall growth of Asian economies. Using this regression analysis, we can do a counterfactual policy experiment. So right now, 0.5% GDP, this amount of money is devoted to PPP financed infrastructure investment. Okay. Using this cross-country regression analysis and estimate parameter, we can do counterfactual simulation. What happens if PPP amount has been doubled? So 0.5% of GDP investment currently increased to 1.0% investment through PPP. Then, according to our data, our study, 12 million more people can get access to safe water, 14 million more people with electricity, and cross-country growth regression data analysis showed us additional 0.1 percentage points in GDP growth. As I said, 5.9% growth over all Asia this year. This is our growth forecast. So doubling PPP can push up our growth 5.9% to 6.0%. So this is the our overall broad impact assessment of PPP. Theoretically speaking, because of mobilizing private sector's dynamism, we can improve overall infrastructure delivery. Indeed, our data shows and supports this theoretical mechanisms. Having this said, PPP is not panacea. We see some PPP failures, and according to our database, past quarter-century database, $46 billion committed PPP ended up being canceled, which amount to 6.3% of all committed PPP. Of course, more than 93% of PPP committed, implemented, and seems to be successful. So proportion seems to be not large, but still 6.3% PPP didn't work. So using project data, we can explore what's the determinants of success of PPP and failure of PPP. So we did the survival analysis or duration analysis to estimate the survival probability of PPP. According to our study, we identify largely 4 factors important to make survival probability of PPP better. Number 1 is project-specific design. Number 2, institutional arrangement. 3, macroeconomic environment, socioeconomic stability, finally. Project design, we found, according to our study, unsolicited project, PPP project, seems to involve lower success probability. So solicited probability with competitive bidding seems to increase PPP survival. And greenfield project rather than brownfield seems to increase survival. And risk allocation within project seems to enhance PPP survival, especially involvement of multilateral development banks such as ADB and World Bank seems to enhance risk allocation and survival probability. And institutional setting, so if a government which hosts the PPP project, if government has a dedicated independent PPP units, then survival probability seems to be higher. And macroeconomic environment, overall growth rate is higher, then survival rate seems to be higher. Overall government debt GDP ratio seems to be negatively related to survival probability of PPP. So if government indebtedness is more serious, then lower survival of PPP. Finally, governance or ecological condition, degree of law and order, and the degree of corruption seems to be systematically related to PPP survival probability. Better regulatory environment, then higher survival probability. Higher degree of corruption seems to be negatively correlated with survival probability of PPP. So this is the study we found using project level data. So now, as I said, $1.7 trillion investment needs in Asia to continue growth. Okay? But there are some significant gaps exist. Okay? how to mobilize private money. Is there any money available globally? Answer is definitely yes. As you know, globally speaking, we have big money held by institutional investors, pension fund, mutual fund, insurance fund, and sovereign wealth fund. Okay? So they are having a huge amount of money. There are some different estimates, but 75 trillion US dollars to 100 trillion US dollars, that scale of money is available, and zero interest rate or negative interest rate. So these investors are potentially seeking for good investment opportunities, high return opportunities. Okay. Now Asia, 6% growth or more, and growing continuously. So potentially Asia can supply high return investment opportunities and potentially bankable projects. So issue is how to connect these two. Big money available, and Asia is in need for infrastructure investment. Okay. Current situation, Asians' investment in infrastructure seems to be financed dominantly by bank financing. So actually, equity and debt and equity seems to be a dominant mode, and banks has been playing a very critical role in Asian infrastructure investment. But banks, there is a potential problem of so-called maturity mismatch. Infrastructure project has a long gestation period, long investment is needed, then long-term generating a positive return. Okay. But bank financing is in nature short maturity. So there is a issue of maturity mismatch. And if money is coming from a foreign bank, then another mismatch, currency mismatch. And actually, Asians' investment, overall investment, seems to be still depend on dollar-denominated borrowing. So this double mismatch problem we still observe if we closely looking at data. So in this respect, bond financings are more desirable, and especially local currency denominated bond financing of infrastructure. That's really important to fundamentally solve this double mismatch problem of maturity and currency mismatch. So next question is how to tap this institutional money and putting this money into Asia's infrastructure investment. So actually issue is risk gap. So Asia continuously growing, so potentially Asia's investment in infrastructure can generate positive return, but associated with high cost, high risks. Part of risk is originated in country risk. Other part of risk is originated in underdevelopment of broader capital market, especially local currency denominated bond market. So in order to tap institutional investors, a bridging risk gap is definitely needed. And the infrastructure financing gap, in other words, is essentially a risk gap. So how to match this? So there are a number of instruments to make PPP project in Asia more attractive. So listed here, credit enhancement, partial credit guarantee, revenue guarantee, typically, public infrastructure investment, finance through PPP, government, it's typical to government to offer revenue guarantee. So after constructing subways, if a number of passengers is not enough to support enough revenue, then government has this contingency clause saying that the government can offer some revenue guarantee. And bond guarantee to facilitate bond issuance, project completion risk guarantee, and also some type of subordinated debt. These instruments can be available to facilitate more private sector investment. And in this respect, multilateral development banks such as ADB and World Bank has been and will be play a very important role. MDB can provide a credit enhancement products, credit guarantee, also some type of a broader governance guarantee. Also, MDBs can support and provide quality expertise and knowledge to facilitate project preparation, implementation, and completion. So this is theoretically needed to facilitate more private investment in infrastructure investment in Asia. And again, MDB have an important policy role in promoting PPPs. So ADB, for example, provided, in some cases, provided partial credit, political risk guarantees, and credit market development. ADB has been, capital market development, ADB has been playing a very important role in facilitating a local currency bond market in Asia. And also broader policy support ADB has been providing through a policy-based lending scheme. ADB now established Office of PPP, which provide advisory services for the private sector to prepare PPP projects. So to summarize, what's the needed components to make PPP more bankable and viable and tap private institutional assets in developed countries? There are three P's we listed here. First of all, suitable projects should be properly designed or selected. Constructing a rapid speed trains in middle of nowhere, a sparsely populated area, that kind of project won't fly. Okay, so first of all, suitable project should be properly selected and or designed. In this respect, standard cost-benefit analysis play again important role, and also government may consider broader positive social benefit. In any case, really careful technical works are needed. Secondly, selecting and also implementing these PPP-based project, a qualified partner should be involved. So those who have basic technical skills to design and implement infrastructure project, plus capacity to adapt innovative ideas and innovative instruments, these are the needed. So qualified partners should be properly involved. So as I said, unsolicited, solicited project with competitive, transparent bidding process seems to play a very important role. And finally, in order to materialize a right project selection or design, and also right partners get together to form a PPP project, right process, right ecosystem should be properly designed. So, regulatory framework should be streamlined and nicely arranged, together with clear, for example, potential conflict resolution mechanisms, and ideally, independent PPP unit should be formed in the government ministry, and so that the different ministries and different stakeholders, intra-governmental, negotiation, cost associated with these things should be minimized. So right process should be clearly set. So these are the critical, indispensable component of successful PPPs. Okay, let me wrap up again. There are three key messages of this year's Asian Development Outlook update. Number one, we revised up our growth forecast of developing Asia and Pacific region on strong trade and growth in China. Now 5.9% growth this year and 5.8% next year. India is still fastest growing largest economy despite some transitory challenges this year. And now we set 7.0% as Indian growth. Secondary trade rebound has been broad-based and synchronized across region, and it seems trade expansion will continue more months. And finally, public-private partnership can be a quite innovative tool to meet Asia's massive infrastructure needs and tap private expertise and private funding possibility. So I think I will stop here, but I would be happy to take questions on these materials. Thank you very much for your participation and listening. Yeah, that's a very critical question. PPP, if corruption is involved and ended up a very inefficient project, then that deficit, generated by this corrupted project, will become contingent liability of government. So this is a really important, serious issue. As I said, two responses. First of all, corruption seems to be statistically, according to our statistical analysis, corruption seems to be closely related with failure of PPP. So corruption should be minimized in order to make, according to historical data, we can say corruption should be minimized. In order to do that, actually, 3 P's. Second point, right stakeholders, right partners should be properly selected. So transparent and competitive bidding process, this should be secured. And unsolicited project, this should be controlled. So that's number one. And number two, in order to materialize this, clear, transparent system should be established. So having an independent PPP unit, organizing a really transparent bidding process and control this process under the really clearly defined, streamlined legal and regulatory framework. I think that's really important. Yeah, and the ADB is sort of supporting this direction, largely speaking. Yes. So demonetization, it's sort of an unconventional policy reform, but the direction seems to be right in order to facilitate digitization of the economy and control some underground use of money and savings. So I think a direction seems to be right, and indeed our forecast shows, although temporal shocks caused by this demonetization, but economy seems to pick up next year and after. Okay. GST, this is also, again, this is a right reform direction because GST can expand revenue in a stable manner. So I think this is a right direction. And indeed, again, our forecast, because of this better kind of revenue structure, we expect India's growth will bounce back next year and onwards. Yeah, actually, I think broadly speaking, I think Asia's return, investment opportunity return is high, but risk is also high. So in order to control or diversify away risk, that's an issue. And I think broadly speaking, insurance markets to diversify away this investment risk in Asia is still developing. So I think we need a two kind of a track system. One is nurturing capital market development so that through the market, these risks effectively diversify away. But it may take time. So, local currency bond market has been growing, especially after Asian financial crisis 20 years ago, but still growing. So in the meantime, we need some project-specific de-risking, mechanism. And in that respect, I think public sector, including local government and also multilateral development bank like ADB, should play a role to diversify away these risks. So I'm not really careful about the general equilibrium type of modeling, how we can understand. But in terms of under this imperfect, incomplete insurance market, probably this is a pragmatic way to proceed. So that's, yeah. So I think our presumption is cost-benefit analysis can identify high return project, but that also associated with high risk. Then pooling this high risk, high return project all together, then we can effectively enhance our overall returns of the bundle of project with moderately diversify away risks. But there is no market to trade these individual idiosyncratic risks specific to projects. So market development should be nurtured on one hand, but on the other hand, we need some public intervention to pool these risks. So I think government and MDBs can play a role. So I think this is the way we are thinking, I think. That's a very important question, and two questions. AIB, Asian Infrastructure Investment Bank, that started a couple of years ago under the leadership of Chinese government. Now it's a multilateral agency. So our position is actually officially, so as we have seen already, 1.7 trillion US dollars investment needed. Overall, probably several hundred billions US dollars unmet demand exists. So far, all multilateral development bank together, ADB and World Bank together, Asia's infrastructure investment, only 2.5% direct investment has been made by MDBs. So number one, our loan size is not really large enough, directly financing overall infrastructure. Although MDBs provide non-monetary kind of support, expertise, and also project preparation, support, etc., and also policy support. So that's the number one. So after all, MDB's loan capacity is quite limited. Although ADB has been engaging in capital structure reform so that we can double loan size in next few years. So in this condition, and we need several billions US dollars, several hundred billions US dollars we need to somehow bridge the gap. In this condition, actually ADB and AIB, I think it's not a situation where we should compete, but rather we should collaborate to maximize our filling the gap, operations. So indeed, ADB and AIB exchanged and entered MOU last year, May 2016, when ADB held an annual meeting. We exchanged MOU, and under this MOU, we started a co-financing project. Already 4 projects started, highway project in Pakistan, and energy sector, renewable energy sector project in Bangladesh, Georgia, transportation sector, and the India energy sector. So 4 projects we have been already started. So I think this direction will be continue. Yeah. And with that, we hope at least partially we can fill in the gap. So that's ADB, AIB. One Belt, One Road, or Belt and Road Initiative, that's another big kind of a trend originating Chinese, under leadership again of Chinese government. Belt and Road Initiative, BRI, forum was held earlier this year. And at the time of forum, Chinese Ministry of Finance and 6 multilateral development bank, including ADB and World Bank, AIB and New Development Bank, and European Development Bank, etc. So we exchange MOU. So now we are in a position, potentially we can support Belt and Road Initiative. Okay. ADB basically thinks if there are bankable project and good project, roughly speaking, if good project under the BRI initiative available, and that project is consistent with our ADB's country partnership strategy with each client countries, then we can support Belt and Road Initiative. So that's our position. On the other aspects, Belt and Road Initiative is nothing but we see this is a kind of a regional cooperation integration program. So looking at a group of countries as a cluster, and then investing in cross-border infrastructure, road network, bridge, and energy, information technology. So facilitate investment in this cross-border infrastructure so that the whole region can develop. And also, or in other words, internalize positive spillover effect across border and minimizing a negative spillover effect across country, then maximizing development capacity of whole group of country. So that's a regional cooperation integration idea. And Belt and Road Initiative is nothing but this regional cooperation and integration framework. And indeed, ADB has been helping greater Mekong sub-regions, Mekong Delta countries together with 2 provinces, China, Southern China. We have been helping this regional cooperation integration through helping investment, cross-border infrastructure investment since early 1990. And also CAREC initiative, Central Asia Regional Economic Program, CAREC program. In Central Asia, we are doing same thing, helping infrastructure investment, also policy dialogue and policy kind of coordination all bundled together. So we have been doing this. Also involving a Chinese, some Xinjiang Uyghur province. SASEC, South Asia, we do same regional cooperation integration program. So actually, from the ADB viewpoint, Belt and Road Initiative basic idea is similar to the idea of Greater Mekong Sub-region, CAREC, and SASEC program. And we already entered the formal framework by exchanging MOU. So again, if there are good projects which is consistent with ADB supporting strategy, then we help BRI. Having said this, BRI, they held a forum, but even BRI member are not well defined yet. It's kind of evolving over time. So after all, I think we need to see what will happen. And then if there are rooms for collaboration, then ADB will collaborate. I think that's the current situation.